morning, Legal Latte family. I am Angela. I'm coming back again this week. Jessica is still out. And so this week, for this week's episode, I wanted to talk about when revenue grows, but your tax bill grows faster. Okay. In the legal industry, success is often measured by revenue. Firms celebrate hitting $1 million in revenue, or doubling their cash volume, or signing more clients than ever before. And those are real milestones worth celebrating. But today I want to talk about something many law firm owners discovered the hard way. As revenue grows, your tax exposure often grows even faster. And if you're not planning ahead, that success can come with a pretty uncomfortable surprise. Let's talk about why. The first reason is simple. Taxes are based on profit, not just revenue. So if your firm is experiencing a strong year and your margins improve, your taxable income increases. That means your estimated tax payments should increase too. But many law firm owners continue making the same quarterly payments they made the previous year. Then, when tax season arrives, they discover a large balance due. The second issue is timing. Revenue might come in waves, especially for firms that rely on contingency cases or large retainers. But the IRS doesn't care when the revenue feels stable to you. They care about the total taxable income for the year. Without regular financial review and projections, it's easy to underestimate how much tax you actually owe. That's why tax strategy shouldn't start in April. It should happen throughout the year. When we review financials monthly and project profitability forward, we can estimate tax exposure early. That gives you time to adjust. For example, increasing retirement plan contributions, timing certain business purchases, evaluating whether your entity structure still makes sense, or adjusting owner compensation strategies. These are just a few, but each of those decisions can impact your tax liability in a meaningful way. Another factor many law firm owners overlook is how growth changes their tax profile. When you move from a small firm to a large firm, more profitable operation, new strategies become available and sometimes necessary. So things like S corporation compensation planning, advanced retirement plans, hiring credits, and other incentives, or more sophisticated deduction timing. But these strategies only work if they are implemented early enough. Once the year closes, most of those opportunities disappear. This is where strong financial systems come back into play. Clean monthly accounting gives us reliable numbers, forecasting tells us where profit is trending, and tax planning allows us to adjust the strategy before the year ends, not after. The goal isn't just to reduce taxes. The goal is to avoid surprises and make sure your success translates into sustainable financial growth. Because your firm grows, your strategy should grow with it. So here's the takeaway that I want you to remember. Revenue growth is exciting, but without tax planning, without the proper books, the growth can create pressure instead of progress. When your financial systems, forecasting, and tax strategy all work together, you turn growth into something much more powerful, and that's predictable success. And before we wrap up today, I'll leave you with this. May your coffee be strong and your tax strategy even stronger than your revenue growth. Thank you, and I hope you enjoy the day.